Welcome back, everyone, to the last part of our Understanding Leverage module. Today, we're going to be discussing margin management within our swing long trade. So let's just jump right in. If we remember from the previous video that this was our swing long trade setup, extensive journaling showed that this trade had an extremely high win rate. My system dictated that I should enter the setup using the LTE framework. But what about the exit strategy? My system highlighted the need for a more hands-on approach compared to my usual set and forget method. Let's see what happened as this trade progressed. A couple weeks into this trade, and I got an alert one afternoon that price had broken my original take profit target. By the time I had checked the chart, I noticed that it blew right through the level and was still trading above. Now at this point, I had one of two choices I could make. I could either take profit and mark the trade as a larger than expected win, or I could manage the trade and let my winning position run. Since this was a swing trade, my time horizon for the trade duration allowed me to zoom out on the charts. And look what happened when I did. After zooming out to the 2-day time frame, I noticed something very important. The asset was about to close within the Ichimoku cloud and greenlight one of my bread and butter trading setups. Now, I won't get into the specifics since I'll save that for the next course, but just know that journaling and experience had shown me that this new setup had an even higher win rate than my original trade setup. This trading setup was one of my system's strongest edges in a trending market. Furthermore, the risk-reward profile of this new setup was astonishing. Utilizing the same entry and stop loss, I managed my trade and allowed the potential R multiple to evolve into a 14.9 risk-reward profile. My new take profit target was now 282, over 100% from my entry. That means for every Bitcoin that I risked, I stood to potentially earn almost 15 Bitcoins of profit. This was one of the many reasons I have preferred to trade the cryptocurrency markets. Rarely do you see trading opportunities for 100% returns over the course of a couple months. Yet, this Ethereum swing long was staring me in the face. Let's pause for a second and break down our new potential trade. Now we can see here from our trade parameters, the change was in the new take profit target. As a trader managing a trade, our risk-reward ratio changes as a trade progresses, and we try to milk a winning position for all that it's worth. In this specific trade, the new potential profit multiple was over 5 times the initial one. However, I want to draw your attention to the screenshot at the bottom. What sticks out at you like a sore thumb? If you said the profits, you are mistaken. Remember, notional profits or losses should not impact our trading behavior or our decision making. Trading is a game of percentages. Now, if you said the liquidation price, you would be correct. We'll notice our liquidation price is now $126.35. What gives? Didn't we calculate our liquidation price to be $122.95 based on our original 10x leverage? Yes, we did. However, we didn't talk about an important part of trading derivatives. Remember how I said that I took this long via BitMEX's perpetual swap for the Ethereum US dollar pair? Well, the perpetual swap product is subject to funding periods. Now we won't go in depth into funding in this module. Tripp, however, will speak about it at length in the next course. However, the important takeaway here is that throughout the duration of this trade, I was paying short traders funding in order to maintain a long position on margin. That means that every 8 hours, a percentage of my account margin was drawn upon in order to hold my long position. Since my margin was slowly being eaten by funding, my liquidation price started moving up higher. it actually moved up to a price that was higher than my initial stop loss. Now, if you'll remember, I had two choices I could make. Based on the information at hand, I took a calculated risk that price would continue trending upwards towards my target at a rate that would outpace the margin being eaten by funding. It was here that I decided to move my initial stop up to my original entry at 135 in order to cover the funding fees in the event that the market reversed in the opposite direction. Now, I want to direct your attention to what happened over the next couple months. Price did continue its upward trend to my new take profit target, but unfortunately, there's a twist to the story. Price actually ended up missing my limit order by 10 cents at the time. The highest price the BitMEX pair reached was $281.90, while my sell orders were at $282 even. Now imagine having watched this unfold in real time and deciding how to react in the moment. By this point, funding had become increasingly more brutal for long positions, and at one point I was paying over 1% of my notional position per day in funding alone. It was at this point that I made the executive decision that I had milked this position for all that it was worth. I dropped to a lower time frame and exited my position around 268 via the LTE framework. Now let's do a quick post-mortem analysis on the trade and the key takeaways when trading on margin. The right use case for leverage is to use margin as a tool to mitigate our counterparty risk, as well as capitalize on our system's edge. If my portfolio had been only 50 Bitcoins, then margin would have been even more necessary to adequately size my position for the opportunity. The wrong use case for leverage is to use margin as a tool to arbitrarily increase our risk by trading sizes outside of our system's predefined risk parameters. Remember how I mentioned I had paid funding? Well, the post-mortem of this trade should give you a strong inkling of what role leverage can play within a trade that is managed over many weeks or even months. Funding ended up eating over 20% of my total profits on this trade. Now, had I closed the trade at my original target, I would have not paid nearly as much in funding, but the profitability would have been significantly less as well. This is the trade-off we have to make as traders when deciding how to execute our trades. Do we pay funding? Do we use a different instrument or a different exchange? Do we hedge? These are the kinds of questions you'll learn to ask yourself as we progress through this course and touch upon the various ways we can optimize our execution and trading system. Now let's do a quick recap of this module before we move on. As said earlier, I really want to hammer home that leverage is a tool used to minimize risk and optimize our capital allocation. We should not use it as a tool to increase our risk, since after all, leverage is irrelevant. Remember, leverage should never affect our position size. This risk should be predefined before we execute on any trades. Ultimately, margin trading can become a key component of a profitable trading system, but only after we have learned to master the basics. If we struggle to be profitable without leverage, margin only stands to hurt our portfolio, not optimize it. I hope you now have a concrete grasp behind leverage and margin. Thanks for watching, and I'll see you soon.